To understand true valuation, we must look past a paper stock certificate to see the industrial framework operating behind it. This line represents the result of that perspective. Over more than 25 years, Berkshire Hathaway achieved a 23.2% compound annual growth rate, significantly outpacing standard market benchmarks. This record stands as an empirical anomaly, built while ignoring macroeconomic forecasts and the volatility of daily price movements. We are mathematically deconstructing the Buffett valuation model, moving past stock speculation and into the mechanics of capital allocation. This model treats a stock as a fractional claim on a physical business's future cash flows. Many investors rely on the stock market ticker to dictate the value of an asset. To counter this, imagine you own a business with a partner named Mr. Market, who quotes different prices for your stake every single day. His quotes vary by his mood. When euphoric, the price is high. When pessimistic, he offers deep discounts. A rational investor exploits Mr. Market's moods rather than trusting his wisdom. Because market prices are often driven by sentiment, the capital allocator requires an objective framework to calculate intrinsic value independently. This framework rests on 4 pillars, beginning with the business tenets. These tenets divide the economic landscape into commodity businesses and franchise businesses. A commodity business competes strictly on price, selling products that are completely indistinguishable from those of its competitors. This lack of differentiation results in low profit margins and high vulnerability to market shifts. Conversely, a franchise business provides a needed product with no close substitutes, allowing it to operate in an unregulated market. This structural advantage creates an economic moat. It grants management the pricing power to raise rates to offset inflation or internal errors. Identifying a franchise is the first step in the model, as these businesses are built to survive cycles and protect capital. After identifying the business type, we move to the financial tenets to analyze hard accounting metrics. This requires looking past earnings per share, a metric often used by analysts, but one that hides a significant flaw. Earnings per share ignores the mandatory capital expenditures a company must spend to maintain its unit volume and competitive position. The Buffett model uses owner earnings. Starting with net income, it adds non-cash depreciation and subtracts maintenance capital expenditures to reveal actual surplus cash. Unlike high-asset companies that consume profit to stay operational, a franchise generates a massive cash surplus. Owner earnings provides an objective measure of the surplus cash a business creates. The third pillar, the management tenets, examines how executives deploy that surplus cash. Managers often succumb to the institutional imperative, the tendency to mindlessly mimic the actions of their peers. Every company follows an economic life cycle. At maturity, cash generation exceeds growth needs. Many managers irrationally reinvest this cash into projects with diminishing returns. Conversely, if cash earns less than the cost of capital, it must be returned to shareholders. While the business generates cash, management's discipline in allocating that capital determines the long-term value of the investment. In the final pillar, the market tenets, we convert these observations into a mathematical valuation. A company's value is the sum of the net cash flows expected over its life, discounted back to the present day. This table calculates that value by projecting the owner earnings we identified earlier. We start by compounding those earnings at a conservative rate, in this case 15%, across a 10-year horizon. We then apply a discount rate, such as the 30-year Treasury bond yield. This adjusts future earnings for inflation to reach their present value. By adding this to the projected residual cash flows, we arrive at a business value of roughly $16 billion. This process produces an objective valuation that remains independent of market sentiment. With the intrinsic business value estimated through these specific projections, we can compare the output to the market price currently offered by Mr. Market. The gap between the intrinsic value and the market price is the margin of safety. Buffett typically seeks a 25% discount below his calculated value. This acts as a buffer against risks or errors in projection. This margin of safety ensures that the underlying investment can withstand severe economic shocks while remaining completely unbroken and physically intact. This model synthesizes Benjamin Graham's mathematical discipline with Philip Fisher's qualitative focus on business franchises. Investing is most effective when it is conducted with the rigor of a business acquisition. Investors following this rigorous approach view market crashes and pervasive pessimism solely as rare opportunities to buy at a massive discount. This requires the patience to say no indefinitely, treating your career as if you only have a 20-punch lifetime decision card. By applying these 4 tenets, Berkshire Hathaway achieved its growth while remaining completely indifferent to the wildly fluctuating stock ticker. Long-term financial success follows the application of rigorous logic to the acquisition of cash-generating assets, regardless of market sentiment.